You don't need a long list of do's and do not of money, business, or investment if you want to travel successfully to financial freedom. All you need is a basic understanding of the principles that govern investment. To live a financially free life, you can't rule out the place of investment. Not just investment, but profitable investment. This is because there is a limit to how much you can work and earn all by yourself. Listen to this. This is not one of the motivational talks to make you jump into any get-rich-quick schemes or push all your savings into a business you have no idea about. This is just a push to help you know that investment rules the future, and the future is now. Perhaps you are already convinced and you are willing to make an investment but still do not know how to go about it. Then you should still hold. No problem about that. Here are some basic rules to guide you in making the right investment decision. Never forget your set goals. Goals help you measure progress and productivity. You don't just need SMART goals in your academic or career pursuit. You need a SMART goal if you want to invest. By setting investment goals, you are able to check the goal boxes as you journey into your finances. Without a clear and proper goal, you are tempted to freak at every little challenge that affects your investment or even pull out your investment at the wrong time. But having clearly outlined goals will help shape your perception and give you focus regardless of how stormy the stock market may be, and this will help save you from frustration. It is not enough to want to invest. You must be able to define the goals for your investment. Your goal should answer the question of what, why, and even when. Aside from that, when you have pre-established financial goals, it will guide you in taking the right decision that suits your needs and conditions. When you are presented with multiple choices, your goals become the guidelines and criteria to trim the multiple options till you choose the best. What are my investments for? Why am I investing? When should I invest? How much am I willing to spare? For how long do I wish to invest? Etc. Remember, you don't want to make a little profit and then be confused about the next thing to do. Likewise, you don't want your whole finance to be in ruins courtesy of one investment gone wrong. Assets and not cash. Don't hesitate too long. Here it is. Reinvest in assets rather than keeping raw cash. Throw away that ideology that you only need to keep working and saving to become financially free. That's an ancient lie that has left many people living below the poverty line barely a few years after retirement. The reason is not far-fetched. Cash has the propensity to lose value with time. For instance, the purchasing power $1 is likely to depreciate in a few months because of inflation, whereas buying an asset worth the same amount will bring profit because the monetary value of the item would have increased within the passage of the same time frame. So, rather than accumulate cash, investing in assets is the best way to secure your finance. Cash tends to suffer devaluation in the face of inflation, so wisely choose investment options that have the potential to appreciate in value. This will keep your finance growing as changes take place in the investment market. Principles first, process second. This is one of the golden rules of investing. Never invest in what you don't understand. Before you begin to celebrate the initial results a business is producing, understand the principle first and then the process. This is because the sustainability of any business lies in the principles on which the business is built and governed, and the processes involved in the way activities are carried out. Before you make any investment, do proper research and ensure you understand how the business runs and the principles governing its operations. This will help you strategize and know how much of your savings can go into such an investment. Don't be carried away by a result whose process you do not fully understand. You must understand how the business is maintained, makes a profit, and how the profit is used. This will guide your analysis of the possibilities of the company meeting up with its promise of paying the stated return on your investment. And this brings us to the next rule. The bigger the promise, the more the risk. Don't be carried away by big promises that you forget the possible risks involved. The hack here is simple. Don't be carried away by emotions. Control your emotions. Never let your emotions control you. When you fix your eyes on the promises and not the risks, you soon overact. The goal of investment is not to make you emotional. The goal is to make you financially free. Take, for instance, Company A is a tech company that provides cybersecurity services. It promised a 50% return on investment after 6 months for every $5,000 and above investment. With the business model adopted by Company A, all things being equal, Company A is able to make at least 150% profit on your capital investment. And here is Company B with a promise of 75% return on investment after every 3 months. But the business model of Company B affords it a monthly return of a maximum of 20% on every investment made. Chances are that many will tend to fall for the 75% offer without probing further to understand the nature of the business. Your guess is as good as mine. An investment with Company B will lead to loss and not profit at all. Invest for long-term purposes. Investment is not a get-rich-quick scheme. It takes time to yield profitable returns. To get the best out of your investment, you must let time have a great impact on it. This is why you must not invest your emergency funds. Before you begin to earn reasonably well from an investment, you must give it at least 2 years. This brings us back to the rule of understanding the principles and process of a business before investing. If you are not in light of the principles, the time frame may be too long a time to wait. A lot of people have lost their entire capital because they are anxious to get their return on investment almost immediately after they invest. This is not realistic. Every business that promises you a huge return on investment within a brief period of time is most likely a fraud. Be sure you will end up losing your entire capital to such a business. Leverage the OPM rule. While it takes money to make money, you don't have to use your own money. If you are smart enough, you can leverage other people's money to buy real estate. Even saving up a sizable down payment for years is not necessary. For smart investors, the trick is to benefit from other people's money. Of course, you're not exploiting people wrongly. Smiles. Don't get me wrong on that. It's just about maximizing all the available resources at your disposal. If you have successfully understood the previous rules I've mentioned and how to rightly apply them, then you can confidently follow this last major rule, which is the OPM rule. The OPM rule simply means maximizing other people's money. This becomes possible only when you have understood the basic concepts of investing. You might be wondering, how can you make use of other people's money? It could be personal loans from friends and families, where you can get people to fund your projects and agree on how to share profits. In the end, this is a win-win for both parties. And yes, you really don't have to get it right the first time, but make sure you are not trying blindly. Keep all of the rules at your fingertips and ensure to invest based on knowledge and not fear. Do not panic when it seems as if the time is taking long. A little patience might just be all you need to walk into your next level of financial opening. Remember, make sure you follow these rules and you will see yourself daily walking closer to your desired goal. Thanks for watching.